If the 16th largest bank in the United States isn't a safe place to save your money, then where is? And if most banks only insure up to $250,000 and you have $1 million that took you 50 years to accumulate, what can you do? In this video, I'm going to explain why I'm not concerned at all with my investments and how you can set yourself up to not only survive these crazy types of crashes, but actually get incredibly rich while others are scared. I'm Nolan Govea, or Professor G as my students know me, and today in class we talked all about the SVB collapse and what this means, so I wanted to fill you in as well. Basically, this was such a big deal because regular people like you and me were having trouble getting their money out of the bank and were being told that they may not get their money since the bank failed. This wasn't about investors losing their money on an investment. This was about regular people who had their money in the bank and now it's gone. California regulators on Friday abruptly shuttered the Silicon Valley Bank, closing a 40-year-old financial institution that catered to the tech industry and that was the 16th largest US bank. The company's stock tumbled 60% on Thursday and had plunged another 70% on Friday before trading of its shares was halted. The issue that was interesting to me and that should be very interesting to you is that people that didn't even bank there would be affected. Because if you invest in companies that had their money within that bank and then they can't get their money out and they lose all that money, now your investment's in jeopardy because that stock price is definitely dropping and losing value. Tech firms including streaming company Roku and video game developer Roblox were among companies with money there. Roku told investors it had $487 million at the bank, or about 26% of its cash, adding that those funds are largely uninsured. Roblox said about 5% of its $3 billion in cash and securities were held at Silicon Valley Bank. The bank also made balance sheet management errors by putting too much money into long-term bonds, which became a problem when interest rates surged. So SVB basically owed more cash than they had assets available to be able to sell to be able to cover that cash. Luckily, there's this thing called the FDIC, and that's the Federal Deposit Insurance Corporation, which is an independent agency created by the Congress to maintain stability and public confidence in the nation's financial system. So this bank and their customers are getting bailed out massive and seemingly out of nowhere, which seems oddly familiar to the Fed injecting trillions of dollars seemingly out of thin air a couple years ago. Today we're dealing with crazy inflation, so I wonder what this might do if more banks go upside down and everything gets bailed out. Now that's a topic for a different day, but that makes this next section very important, so listen up. So though most of us were not directly affected as customers of SVB, the same type of thing could happen at any bank. So there's 4 main things that you need to do ASAP to make sure that your life savings is safe. The first one is the most obvious, and it's all about picking the right vehicle or where you're actually putting your money. Specifically for putting money into a bank, you want to make sure and see that your money is FDIC insured, which means that it's insured up to that $250,000 mark. So look for that at the absolute minimum. What I like to look for is credibility. There's a lot of new banks that open up, and even purely online like robo-banks, and they make enticing offers like sign up with us and you'll get $500 free or something like that. To me, I'd rather go with safety and security than getting that little $500 up front. Now, most people don't just have their life savings sitting in a bank. Most people have the bulk of their life savings in a retirement account like an IRA or something, which is usually on an investing platform. This is why I always recommend going with something very reputable, usually something old school, not sexy, not cool. I really like Charles Schwab, Vanguard, Fidelity, that type. I like it way more than Robinhood or M1 Finance or these other ones that just aren't proven. I don't have anything bad to say about those, just the fact that they haven't been through a lot and they're still growing as a company. And so I'm scared that they're going to go out of business. Now, these aren't going to be FDIC insured, but what you're going to want to look for is SIPC, which is Securities Investor Protection Corporation. And this is a specific protection for securities. For example, on Charles Schwab, their SIPC provides up to $500,000 of protection for brokerage accounts. Number 2, when people think about investing safe, they're usually just thinking, okay, just don't invest all of my money into 5 different tech companies. Maybe invest in a home improvement company or a consumer staple or a medical company or a financial institution. Too soon? Because diversification is very important, but people forget that that's still all equities, that's still all stocks, and all of that money is still probably all in one investment account. So if that investing platform gets wiped out the same way a bank got wiped out, it's not likely, but it definitely happened, so it could happen, then literally all of your eggs were in that one basket, even though you were diversified within those eggs. So it's definitely about picking the right vehicle from before, but also about picking different vehicles. For this, I have 4 places that I want you to start really heavily researching. Number 1 is real estate. And when I say real estate, I mean actual physical real estate. There's still a level of risk to this, but it's usually something different than what would happen with the digital world. Next would be precious metals. Again, I would go with something physical though. Instead of buying shares of gold or an ETF that has a bunch of gold, I would actually buy a couple ounces of gold or something like that and put it within a safe. Again, if you diversify into gold, but it's really just shares of gold and that's within your investment account and that goes upside down somehow, that's a problem. The next option would be cryptocurrency. Now, especially right now with this crazy volatility, I really only suggest diving deep into what Bitcoin and Ethereum are and just figuring that out for now. And I very much suggest that as soon as you buy it, you take it off of the exchange and you put it into a cold wallet, something like the Ledger Nano X. What that does is it basically takes it from being on the exchange or being on the investing platform to now being yours and like a physical asset. That would be the same thing as saying you have $10 at Chase Bank, but then you go to Chase Bank and you withdraw the $10 and you put that within your own safe. Now you're in charge of it. The last option to diversify would be starting your own business, side hustle, something that's getting you a second or third income stream. Because if something were to wipe out one of your baskets, having a way to make sure that you're bringing more income in will definitely lessen that blow. Now, all 4 of those definitely have their own risks, and that's why I said research each one of them. Don't just go out and do it, but those are the 4 that I really like. Now, number 3 is so important, and the wealthiest people that I know do it, but a lot of people just kind of stay lazy and don't do this one. Now, when I was younger, I played every single sport, but the one that I played the most and just loved to do every single day was play soccer. A buddy and I used to play every single afternoon, and he had this super cool setup, and we played a lot of like trick shots where we tried to score a goal doing something crazy around the backyard. Now in their backyard, they did have a huge window right next to where we used to have the goal, and so his dad got this huge wooden board, and we would just have to put it up every time we were gonna play, and then just take it back down. Now that board was kind of heavy, and also it took like 5 or 10 minutes to put up and get everything right. And one day we just wanted to get some shots in before the sun went down, and I had been getting pretty good and had really never hit that board. So I wasn't too worried about it. So we just decided not to put that thing up, save ourselves 10 minutes and get some shots in. Well, of course I hit that window and absolutely obliterated it. And so not only did that mean that we had to stop playing for the rest of that day, but I also had to give up a number of weekends working so that I can pay back that window that I broke. All because I didn't want to take that 10 minutes to just put up the board and make sure that I was safe. So number 3 is all about safeguarding by using benchmarks. So when you start investing, it's going to be super easy because you won't have very much money. So it'll be very easy to see where all of your money is and to see how balanced your portfolio is, because it's basically going to be you just buying each investment. And so you can keep those percentages pretty straight. But soon your fortune will start to grow, and it's not going to grow equally. I've put about as much money into equities or stocks as I have into real estate, but real estate now is worth about 5 times as much as my stock. So what you should do ahead of time is have a set dollar amount or a set time or a set percentage, and every so often you make sure and look at your whole portfolio, everything you're invested in, and make sure that you don't have unnecessary risk in one area. You don't want 90% of your portfolio in stocks and then 10% somewhere else, because if that 90% is the thing that gets crushed, you're gonna be pretty sad. Now I'll tell you, this is harder than it seems, because usually what's happening is you're gonna have a couple investments that are fast growing and they're gonna be pushing, going crazy, and it will turn into something like 70 or 80% of your portfolio. And you're not going to want to take away that steam and take money out of these things, especially when it's going crazy. But that's the time that you need to be disciplined and take a little bit out and put it into something maybe sustainable, slower growing, but also one that can't really drop as much. If you don't set the benchmarks or set the exact time ahead of time, you'll never do it. So for me, I rebalance my portfolio once a year, but I do know people that do it every 3 months or every 6 months. Number 4 on this list to do is definitely a tough one, but this is the one that could get you really rich. So when the news came out about SVB and everything was going crazy, my first thought was definitely, oh man, I felt terrible for the people. And I knew that a lot of lives were going to be affected and my heart really went out to them. But I also knew that because of this, there was going to be crazy fear in the market. So I checked the market and over the next couple days, of course, everything was dropping like crazy. I forget where I heard the quote, but I'll always remember, never waste a crisis. Although this was terrible and a bunch of people were affected, this was the perfect time for me to strike and get some things at a low price. But I was only confident because of my research. The final and definitely most important thing that you need to do is you need to research the heck out of whatever it is that you think you're going to invest in. Never put money into something that you don't know 100%. Use my channel as a starting point, but then go much, much deeper. Now, in order for you to stay safe with your investing and be disciplined, but have a plan, here's a great video I did that's gonna keep you on track and know what order to invest or to save and when and how much so that you can set yourself up for ultimate success no matter what craziness happens.